A retiree holding $500,000 in a seemingly safe cash account will quietly lose over $240,000 in purchasing power across 25 years without spending a single dime. While Wall Street volatility terrifies cautious retirees into hoarding cash, inflation acts as an invisible tax that steadily evaporates your hard-earned nest egg from the inside out. Today we will uncover the exact mathematical tipping point where cash becomes dangerous, alongside the 3-bucket allocation strategy that protects lasting wealth across 3 full decades. Consider Robert, a 65-year-old engineer who just retired with $1.2 million in bank certificates, completely confident that avoiding stocks guaranteed him absolute peace of mind. If you want the real, unvarnished truth behind slow and lasting wealth without get-rich-quick hype, hit subscribe right now. Let's get straight into the exact mechanics. Robert assumed that a steady 4% interest rate on his cash pile meant his retirement lifestyle would remain permanently secure. That assumption proved fatally flawed. The fundamental trap lies in confusing nominal interest rates with real purchasing power. Whenever annual inflation averages 3%, your actual net return drops to nearly zero. Furthermore, Uncle Sam taxes your entire 4% nominal yield as ordinary income. That immediate tax bite pushes your net income well below inflation every single year. Think of holding an all-cash retirement portfolio like walking up a downward-moving escalator. Unless your investment gains outpace that mechanical descent, you inevitably slide backward over time. Over a single decade, a modest 3% inflation rate silently erodes 26% of a dollar's buying power. Your typical $100 grocery basket suddenly costs $134. Why do intelligent savers voluntarily choose guaranteed purchasing losses over market fluctuations? Human psychology is hardwired to prioritize immediate emotional comfort above long-term mathematical survival. Historical market data since 1928 confirms that cash equivalents barely match inflation after taxes. Meanwhile, diversified equities generated roughly 7% in annualized real gains above inflation. By year 10 of retirement, Robert realizes his $4,000 monthly cash withdrawal no longer covers rising healthcare bills. He must begin pulling heavily from his core principle. While financial planners constantly warn about market downturns, a prolonged sequence of inflation risk is far more dangerous because lost purchasing power almost never experiences a recovery bounce. Consider medical expenses specifically. Healthcare costs for American seniors historically climb at double the baseline inflation rate, dramatically accelerating the depletion of fixed-yield cash accounts. Locking your life savings entirely inside bank reserves is like storing an ice block in a bank vault. The vault prevents theft, but it never stops the melting. Because modern medicine gives a retiring 65-year-old couple a 50% chance of reaching age 92, multi-decade cash drag transforms into an existential threat to financial independence. To preserve genuine wealth without losing sleep over stock crashes, successful retirees never abandon cash completely. Instead, they convert excess cash into a disciplined, time-segmented buffer system. Bucket number 1 is your immediate liquidity shield. It holds strictly 1 to 2 years of basic living expenses inside high-yield savings to cover immediate daily spending. Capping this first bucket at 24 months of expenses guarantees you never sell equities during a bear market, while strictly limiting the capital exposed to inflation drag. Bucket number 2 serves as a stabilization bridge for years 3 through 7, utilizing Treasury, inflation-protected securities, and short-term bond ladders to secure steady, inflation-adjusted yields. Unlike standard certificates of deposit, Treasury inflation-protected securities automatically adjust their underlying principal upward alongside the consumer price index, neutralizing inflation risk backed by the federal government. Finally, bucket number 3 represents your long-term growth engine, consisting of low-cost equity index funds dedicated to funding lifestyle expenses 8 years or more in the future. Because your next 7 years of cash needs are insulated inside buckets 1 and 2, this third growth bucket can easily absorb market downturns with absolute composure. When Robert restructures his $1.2 million all-cash nest egg into this exact 3-bucket architecture, his projected 25-year terminal wealth jumps by over $600,000 without adding reckless risk. During your annual portfolio checkup, dividend yields and capital growth from bucket 3 systematically harvest downward to replenish bucket number 1. Preserving your continuous cash liquidity shield. If equity markets suffer a temporary drop, You simply pause harvesting from bucket 3 and draw down bucket 2, granting your stocks several years to fully recover. Many retirees believe federal deposit insurance shields them from every hazard. Yet while FDIC protects against bank failures, it offers zero defense against purchasing power destruction. Corporations that consistently raise annual dividend payouts provide an elite economic shield, because underlying corporate cash flows naturally expand whenever consumer prices rise across the broader economy. However, implementing this exact structure requires avoiding 3 dangerous withdrawal mistakes that can trigger massive unexpected tax penalties during your first 5 years of retirement. To see the real danger of a cash-heavy retirement, you must understand how inflation compounds against your nest egg over time. At just 3% annual inflation, the rule of 72 dictates your dollar loses half its purchasing power every 24 years. If you park $500,000 in a standard bank vault today, that exact same balance buys only $250,000 worth of groceries 2 decades later. Unlike a stock market crash where prices eventually recover, purchasing power lost to systemic inflation almost never returns to the consumer. Behavioral psychologists call this the money illusion, where our brains focus entirely on nominal balances while ignoring the shrinking real value below. Even worse, the headline Consumer Price Index rarely matches the actual cost increases experienced by an American retiree living on fixed savings. While government inflation statistics track cheaper electronics and apparel, older retirees spend heavily on healthcare, prescription drugs, and rising property taxes. Over the last 20 years, medical care expenses have risen nearly double the rate of broad inflation across the United States. When your personal inflation basket runs at 5%, a static cash account drains significantly faster than conventional retirement calculators predict. Many savers currently feel protected because high-yield savings accounts and certificates of deposit offer seemingly generous 4 or 5% returns today. However, ordinary income taxes immediately slice away a large portion of those annual interest payments before you ever spend a dime. If you earn 5% interest but pay 24% in taxes, your net yield barely breaks even against basic living costs. Furthermore, short-term cash yields carry severe reinvestment risk whenever the Federal Reserve eventually begins lowering its benchmark interest rates across the economy. When a 1-year certificate of deposit matures during a rate-cutting cycle, you face the harsh reality of renewing at significantly lower yields. Long-term bonds lock in guaranteed coupon payments for decades, whereas pure cash reserves instantly absorb every downward adjustment in monetary policy. Combine falling cash yields with a 30-year retirement horizon, and longevity risk suddenly transforms into an acute financial crisis for conservative households. Faced with dwindling interest income, retirees often react by drastically cutting their daily spending, sacrificing the quality of life they worked decades to achieve. Keeping all your wealth in cash eliminates stock market volatility entirely, but it trades temporary market fluctuations for guaranteed purchasing power destruction. Remember that commercial banks actively profit from overly conservative retirees who leave surplus hundreds of thousands of dollars sitting in low-yielding deposit accounts. Institutions lend your capital out at 7 or 8% for mortgages while returning just a fraction of that profit to your personal balance. This massive gap represents your opportunity cost, the invisible wealth transfer moving directly from your retirement savings right into institutional balance sheets every single day. To build lasting financial security, we must stop viewing cash as an investment asset and start treating it purely as a tactical liquidity tool. Cash exists solely to cover your near-term living expenses and unexpected emergencies without forcing you to sell stocks during a market downturn. For most retirees, holding between 1 and 2 years of net portfolio withdrawals in liquid cash provides sufficient psychological and practical safety. Once your emergency reserves exceed that 24-month threshold, every surplus dollar becomes actively exposed to long-term purchasing power erosion. Smart wealth management solves this exact dilemma by dividing your retirement capital into distinct time horizons, commonly known as asset bucketing. Bucket 1 holds your short-term bank cash and treasury bills, carefully shielding your immediate living expenses from sudden stock market volatility. Meanwhile, Bucket 2 utilizes treasury inflation-protected securities and high-grade corporate bonds to generate reliable income across your intermediate 5 to 10-year horizon. Finally, Bucket 3 preserves long-term purchasing power by keeping the remainder of your wealth invested in productive, compounding global equities. But to make this multi-bucket strategy work without triggering unnecessary capital gains taxes, you must master the exact mechanics of annual rebalancing. While holding $200,000 in cash feels emotionally soothing today, that fortress quietly dissolves when you examine a 25-year retirement timeline. If your money market fund pays 4% nominal interest, federal and state taxes immediately slice your actual return down to roughly 2.8%. Subtract 3% inflation from that after-tax yield and you are mathematically locking in a guaranteed loss of purchasing power every single year. Under the rule of 72, a modest 3% average inflation rate will cut the real value of your cash reserves in half in 24 years. Worse yet, the Standard Consumer Price Index severely underestimates retirement costs because seniors spend disproportionately more on healthcare and property insurance, not electronics. Over the last 20 years, medical care expenses have risen at nearly double the rate of general consumer goods across the United States. Consider Robert, who retires at 65 with $500,000 sitting in high-yield savings accounts, believing he has eliminated all financial risk. To maintain a $40,000 lifestyle, Robert must withdraw increasingly larger dollar amounts each year just to buy the exact same basket of groceries. By year 15 of his retirement, 4% annual inflation forces Robert to withdraw over $72,000 simply to match his original living standard. Because cash generates zero real capital appreciation, Robert completely drains his account by age 78, running out of money just when medical needs peak. This happens because our brains suffer from loss aversion, making the visible drop of a stock market decline feel far more dangerous than invisible inflation. A market crash is like a glass shattering on the floor, while inflation is an ice cube quietly melting away on your kitchen counter. Both events destroy your wealth, but the melting ice cube never triggers your emotional alarm system until only a puddle of water remains. Even locking in 5% certificates of deposit fails over decades, because when those notes mature, reinvestment yields often drop right back near zero. That phenomenon is called reinvestment risk, and it leaves conservative retirees scrambling for income during periods of aggressive Federal Reserve interest rate cuts. Institutional wealth managers never hold excess cash. Instead, they calculate a strict liquidity runway designed solely to cover short-term spending during market downturns. The golden rule among seasoned financial planners is holding no more than 18 to 24 months of net living expenses in liquid cash reserves. That 18-month cushion is precisely calibrated because the average historical bear market recovery in the United States takes between 14 and 22 months. When your cash buffer expands beyond 2 years, you suffer from severe cash drag, permanently capping the compound growth needed to outrun long-term inflation. Historical data confirms that a retirement portfolio heavily tilted toward cash has an 80% failure rate over a 30-year payout horizon. Conversely, productive equities survive inflation because solid American corporations simply raise the prices of their goods and services when currency devalues. Furthermore, blue-chip dividend-paying companies have historically grown their cash payouts faster than consumer prices, creating an internal compounding shield against currency erosion. You must recognize that short-term market volatility is not your enemy. Rather, it is the exact price you pay to secure lifelong purchasing power. If you require absolute dollar safety for upcoming expenses, Treasury inflation-protected securities guarantee that your principal adjusts upward directly with official inflation metrics. Unlike a standard bank account where inflation erodes your balance, these federal bonds structurally increase your core principal every time consumer prices rise. However, even inflation-protected government bonds only preserve existing wealth without generating the substantial real growth required for a 35-year longevity horizon. The smartest wealth builders replenish their 18-month cash reserve exclusively during strong market years, harvesting stock gains when equity valuations sit near all-time highs. When a recession inevitably strikes, you stop selling equities entirely and live strictly off your cash buffer until markets complete their natural recovery cycle. This disciplined structure completely insulates you from panic selling at market bottoms, while simultaneously protecting your core capital from the silent devastation of currency devaluation. But how can you precisely calculate whether your current savings balance has already crossed the dangerous threshold from prudent safety into guaranteed financial erosion? To escape the trap of cash drag without gambling on speculative stocks, retirees must build a structured three-bucket defense system that neutralizes inflation directly. The foundation of this architecture is your immediate cash buffer, which should hold exactly 1 to 2 years of baseline living expenses and nothing more. On a $1 million portfolio, keeping $80,000 in a high-yield savings account guarantees immediate sleep-at-night liquidity, while freeing $920,000 to actively fight currency devaluation. Hoarding 5 or 10 years of cash is a catastrophic structural error because every excess dollar sitting idle beyond year 2 silently bleeds purchasing power daily. Right outside that bank reserve sits your secondary liquidity layer, built strictly from short-term treasury bills that mature between 3 and 6 months. Rolling over a short-term treasury ladder continuously captures prevailing market interest rates, delivering government-backed yields without exposing capital to long-duration interest rate crashes. For funds needed between years 3 and 8, you deploy Treasury inflation-protected securities, commonly referred to across US markets as TIPS. Unlike traditional fixed income bonds, TIPS automatically adjust their underlying principal balance upward every month to match the official consumer price index precisely. If cumulative inflation jumps by 6%, the principal value of your TIPS bond expands by that exact percentage, mathematically guaranteeing your real spending power remains intact. In sharp contrast, traditional long-term nominal bonds get pulverized during inflationary spikes because rising yield rates force existing fixed-rate bond prices into severe declines. The historic 2022 bond market crash proved that holding 30-year government bonds during high inflation can erode your retirement capital almost as rapidly as risky stocks. To survive a 30-year retirement without running out of money, your third bucket must allocate 40 to 50% directly into productive global equities. Owning shares of premier profitable corporations is the ultimate inflation hedge because successful businesses pass rising raw material and wage costs directly onto consumers. When consumer prices jump by 10% across retail shelves, dominant corporations increase their revenues by that exact margin, allowing them to consistently raise cash dividends. Broad market index funds like the S&P 500 act as a self-cleansing economic engine, systematically replacing stagnant firms with high-growth innovators that outpace currency erosion over decades. By shifting your mindset from selling shares to harvesting growing dividend streams, you completely insulate your daily lifestyle from temporary stock market volatility. If your stock portfolio generates $40,000 in annual dividends that expand by 6% yearly, your income easily outpaces 4% inflation without selling a single share. This three-bucket structure solves the dreaded sequence of returns risk by eliminating the need to liquidate depressed equities when a recession strikes early in retirement. When the stock market drops 20%, you simply pause share sales and fund your monthly living expenses straight from your 2-year cash and treasury buffer. The built-in liquidity bridge gives your productive stocks 12 to 24 months to fully recover, preventing temporary market drawdowns from becoming permanent wealth destruction. During strong bull markets when equities surge above your target allocation, you trim profits systematically and replenish your short-term cash buffer back to its full 2-year capacity. Conversely, during a deep market correction, your cash buffer absorbs daily expenditures while incoming dividend yields automatically reinvest to acquire undervalued company shares at deep discounts. Real estate investment trusts, or REITs, offer another potent defense against dollar devaluation because commercial property leases typically include mandatory inflation-linked rental escalation clauses. As apartment rents and warehouse lease rates adjust upward each year, landlords pass those increased cash flows directly to investors through reliable, rising quarterly dividend payouts. Do not make the mistake of dumping excess cash into speculative gold or volatile commodities, as those non-yielding assets produce zero regular income to pay monthly utility bills. While gold retains purchasing power across multi-century spans, its prolonged 20-year stagnation periods make it structurally unsuited for generating dependable cash withdrawals during retirement. Smart tax withdrawal sequencing between Roth IRAs, traditional 401ks, and taxable brokerage accounts acts as an additional hidden shield against the steady erosion of consumer inflation. Strategically pulling from taxable brokerage accounts during moderate income years reduces your effective capital gains tax burden, instantly adding thousands of dollars in real spendable purchasing power. Adopting dynamic spending rules during high inflation years, such as trimming discretionary travel budgets by just 10%, mathematically dramatically increases a 30-year portfolio's overall survival probability. Ultimately, true retirement safety is not achieved by hoarding dead cash in a bank account, but by orchestrating a balanced portfolio that continuously grows faster than living costs. To stop this silent erosion without taking reckless risks, you must replace your single stagnant cash pile with 3 precisely calibrated tiers of retirement liquidity. Bucket 1 is your hard cash ceiling, exactly 24 months of baseline living expenses held in checking and high-yield savings without a single dollar more. Why 24 months? Because historical US bear markets take an average of 22 months to recover. completely insulating your lifestyle from forced stock sales. Right now, this primary buffer earns around 4 to 5% annually, which comfortably covers your immediate daily cash flow needs without triggering any market stress. However, every dollar sitting inside bucket 1 beyond that 2-year threshold is guaranteed to lose real purchasing power after state and federal income taxes. That brings us to bucket 2, the inflation-protected bridge that funds years 3 through 5 of your retirement timeline using specialized short-duration fixed income. Instead of holding stagnant cash, bucket 2 utilizes Treasury inflation-protected securities, or TIPS, which directly adjust your principal upward whenever consumer prices rise. If annual US inflation jumps by 4%, your TIPS principal expands by 4% automatically, locking in a guaranteed real yield backed by the government. Compare that defense to a standard bank certificate of deposit, where sudden inflation spikes instantly destroy your fixed coupon and trap your principal without adjustment. Alongside TIPS, this second bucket incorporates short-term treasury bills arranged in a 12-month ladder to generate predictable monthly cash flow with zero interest rate risk. By isolating your 5-year spending needs across these first 2 buckets, you completely eliminate the panic of watching daily stock market drops during a recession. Now examine bucket 3, the long-term compounding engine that holds the remaining 70 to 80% of your total wealth for decades 6 through 30. Because your near-term lifestyle is fully secured by buckets 1 and 2, this third tier can safely remain heavily allocated to productive US equities. Historical market records since 1926 prove that over any rolling 20-year period, a diversified US stock portfolio has never suffered a negative real return. Within that growth engine, blue-chip dividend aristocrats serve as your ultimate private inflation shield by raising their annual payouts faster than consumer prices climb. Companies like Procter & Gamble or Johnson & Johnson have consecutively increased their cash payouts every single year for more than 6 straight decades. When inflation drives up raw material costs, these dominant corporations simply raise retail prices, passing those higher cash flows directly back to you as shareholders. This creates an organic compounding loop where your equity income grows alongside rising living costs, whereas a static cash balance remains permanently frozen in time. Let us analyze a 10-year comparison between 2 retirees, David and Sarah, who both retired with exactly $1 million in liquid savings. David feared stock volatility and parked his entire $1 million inside a high-yield bank account, paying 4% interest, feeling completely safe. Sarah deployed our 3-bucket framework, keeping $60,000 in cash, $140,000 in short treasuries, and $800,000 in equities. Over the next decade, cumulative US inflation surged by 30%, dramatically increasing the cost of housing, healthcare, and daily groceries across the country. After subtracting annual income taxes on his interest earnings and paying those rising bills, David's real purchasing power collapsed by nearly $240,000. Even though David still saw a large nominal balance on his bank statement, his actual ability to buy everyday goods had been hollowed out. Sarah, by contrast, saw her annual dividend distributions grow by an average of 6% every year, easily outpacing the consumer price index. Because her bucket 3 equities compounded undisturbed over that decade, Sarah's total portfolio valuation grew to $1.6 million despite her regular spending. The critical takeaway here is that true financial security in retirement is never measured by your account balance today, but by your sustainable purchasing power tomorrow. When you hoard excess cash beyond a 2-year buffer, you are not avoiding risk, you are simply trading short-term volatility for guaranteed long-term impoverishment. Managing this 3-bucket structure requires just 1 annual maintenance day where you harvest gains from your growth assets to refill bucket 1 for the upcoming year. If the stock market is suffering through a temporary downturn on your rebalancing date, you simply pause equity sales and let your existing bond buffer cover living expenses. Structuring your wealth into distinct time buckets is the ultimate defense against cash drag. You keep exact liquidity for today while allowing growth assets to compound undisturbed. Bucket 1 holds strictly 2 to 3 years of living expenses in treasury bills. This precise cash buffer guarantees your lifestyle without exposing your everyday bills to inflation. By strictly capping your cash at 36 months of expenses, every excess dollar is liberated. That excess capital immediately flows into intermediate assets designed to outpace inflation. Bucket 2 covers years 4 through 10 using inflation-protected treasury bonds. These instruments automatically adjust their principal balance upward whenever the official consumer price index climbs. Bucket 3 holds low-cost equity index funds for decade 2 and beyond. Stocks remain the only historical asset class guaranteed to outrun 30 years of monetary dilution. During strong market years, you systematically trim profits from your equity bucket. You transfer those gains right back into cash to refill your 3-year safety buffer. When market downturns hit, your growth bucket stays entirely untouched. You draw monthly income purely from your cash buffer, allowing equities full time to recover without losses. This mechanical refill rule removes panic from the equation entirely. You never sell stocks at a discount, and you never let idle bank deposits rot from inflation. Remember David and his $400,000 sitting in bank cash? Reallocating into this exact system extended his total portfolio longevity from 22 to 40 years. True retirement security is not about eliminating all market volatility. It is about building an intelligent structure that protects your immediate needs while defeating long-term inflation. When you treat cash as a temporary spending buffer rather than a permanent vault, your retirement income finally becomes unbreakable. That is how real wealth survives. So, holding too much cash guarantees a slow financial bleed, but capping it at 3 years preserves both peace and purchasing power. Hit like if this strategy brought clarity. What exact cash percentage sits in your portfolio today? Tell me below. Subscribe for smart wealth habits and watch this next video on maximizing treasury yields safely.